Understanding pullbacks. A step back before leaping forward. Imagine a rocket launching into space. It doesn't go straight up in a perfect line. It pauses, adjusts its trajectory, and then continues its upward climb. Pullbacks in the stock market are like those pauses. A pullback is a short-term decline in stock prices. It's a natural part of a healthy market. Think of it as a breather for the market to catch its breath. Typically, a pullback involves a 5 to 10% drop from a recent peak. Don't panic. These dips are usually temporary. Pullbacks often represent buying opportunities for astute investors. As prices dip, savvy traders see a chance to buy stocks at a discount. Market corrections. A time for reflection and adjustment. If a pullback is a pause, a market correction is a more significant course correction. It's like the rocket realizing it's slightly off course and needing to make a more substantial adjustment. A correction is a decline of 10 to 20% from a recent market high. Corrections happen more frequently than crashes, but less often than pullbacks. They typically occur every 1 to 2 years. While they can be unsettling, corrections are a natural part of the market cycle. Corrections often present opportunities to rebalance portfolios. Investors can take profits in overvalued stocks and buy undervalued ones. Stock market crashes navigating the tsunami. Now imagine that rocket suddenly exploding in midair. That's a stock market crash, a sudden, dramatic, and severe decline in stock prices. Crashes are relatively rare but are etched in the memories of investors. They are characterized by panic selling and a rapid loss of market value. The most famous crash, the Great Depression, saw the market lose almost 90% of its value. Crashes are unpredictable and challenging to navigate. While crashes are terrifying, they also create opportunities. Investors with cash on hand can buy stocks at significantly discounted prices. Section 4. Distinguishing between pullbacks, corrections, and crashes. Think of pullbacks, corrections, and crashes as existing on a spectrum of market declines. Pullbacks are like small waves, corrections are larger waves, and crashes are tsunamis. Pullbacks are short-term, shallow dips. Corrections are deeper and last longer. Crashes are the most severe, with rapid and dramatic declines. Understanding these differences is crucial for investors. It allows for a measured response based on the severity of the market event. By recognizing the signs and characteristics of each, investors can make more informed decisions. Section 5. The psychology of market volatility, fear, greed, and opportunity. Market volatility, whether a pullback, correction, or crash, evokes powerful emotions in investors. Fear and greed are the two primary drivers of behavior. During a downturn, fear can lead to panic selling, often at the worst possible time. Conversely, greed can drive investors to buy high, hoping for continued gains. Understanding these emotions is key to making rational decisions. Successful investors control their emotions and stick to their long-term strategies. Volatility, while unsettling, is not inherently bad. It creates opportunities for those who can manage their emotions. Section 6. Turning volatility into advantage, strategies for the savvy trader. Market volatility, while daunting, presents unique opportunities for prepared investors. By developing sound strategies, you can turn volatility into an advantage. Firstly, always have a plan. Know your risk tolerance and invest accordingly. This prevents emotional decision-making during market swings. Secondly, consider dollar-cost averaging. This strategy involves investing a fixed amount at regular intervals regardless of market conditions. Finally, remember that pullbacks and corrections are often buying opportunities. Use these dips to acquire quality assets at discounted prices. Volatility is a part of the market. Embrace it, understand it, and use it to your advantage.